So good morning, everybody. We're just going to wait for a few more participants to join, so bear with us. Thank you. Good morning to those that just joined. We've had about another 20 join in the last 30 seconds, so we'll just hold on a little bit further and then get underway. So just bear with us. Thank you. Oh, actually just lost one, so it's going down, not up. Okay, well, the numbers aren't changing too much, so perhaps we will just get underway. So good morning, everybody, and welcome to this insolvency update webinar by McTear Williams Woods in Ipswich. My name is Andrew McTear. I'm a founder and director of McTear Williams Woods, and I'm your chairman for today's event. Insolvency is a bit like buses, and you don't see any change for years and years and years, and then suddenly 3 changes come along all at once. We're going to take you through those changes and cover lots of other ground too. But just before we get into that, a little bit of housekeeping. So if you have any questions, if you could put those on the Q&A tab at the bottom or in chat, then we'll pick those up and deal with those in the Q&A at the end. So if you could raise them as they occur to you, we'll cover that at the end. We're looking to get this presentation done in an hour, and then the Q&A will follow that. We should have you all away safely within an hour and a half, probably quicker than that. We are recording this event so we can put it on the website. So keep your questions clean. And more seriously, you can get access to all the slides you're seeing today through that recording. We are going to be tackling this subject at pace. There's a lot of ground to cover, so hold on to your hats. And finally, if you hear a fire alarm, I have no idea where your fire exit might be. Perhaps we could just move on to the next slide, please. Well, no. There we are. Right. So today's agenda is action packed. We're following this introduction. We're going to have an insolvency update, which Adrian Sage is going to give us, and then we're going to run through business rescue and insolvency options, which is perhaps more a refresher. which Gary Rupping is going to take us through. Then top tips for directors, where you got me again. And then how to avoid unlawful dividends, which Mike Jenner is going to give you, and he's insisted that I only refer to him as Mike for the rest of the presentation. But we do employ several, so that usually causes mayhem, but he's the only other Mike presenting today. And then buying a business out of administration is Gary's going to take us through. And then how to keep lenders on side, which Phil Bailey's going to cover. And then back to all of us as a panel to have a Q&A at the end. So that's the ground. And next slide, please. So just a bit of context for that. This slide starts in Q1 2008 on the left-hand side and works through to Q3 2020 on the right-hand side. The red line is the national statistics for corporate insolvencies. So you can see in 2008, that spiked in Q3 2008 with the global financial crisis, then dropped rapidly, then glided down to below the start point prior to the global financial crisis, and then tracked sideways, and then at the end on the right-hand side, rises a bit and then falls rapidly. And that fall is during the COVID recession, which the Bank of England has said is the deepest recession for 300 years. But corporate insolvencies have halved, perhaps temporarily. The blue line is East Anglia corporate insolvency statistics. You can see that's more volatile, does follow the national trend, but is more volatile as it does that. And that's because the sample sizes are much smaller and a few extra companies in any quarter going bust causes all that movement. And then the black line is a business distress index that we keep, and that monitors all companies that are not micro businesses in East Anglia that are balance sheet insolvent, that are illiquid, and the last filed accounts show a reduction in shareholder funds, which, given that the balance sheet is insolvent, suggests losses. So you can see that increased fairly rapidly during the 2008 recession, then tracked largely sideways. And since 2017 has set off on an upward path, and which continues. And there is, as you can see, a gap highlighted in yellow between corporate insolvencies and companies that appear to be in distress, suggesting a pent-up demand for business rescue and insolvency. Next slide, please. This slide shows the recovery from recessions and how long it takes for GDP to get back to the pre-recession level. And there's a few years and things going on there, but broadly you can see that most recessions, the economy recovers within 2 to 3 years. But the last recession following 2008, it actually took 5 years. And the shape of the recovery so far and the extent of the downturn, the coronavirus has caused the worst recession in the UK, and also, of course, so far the strongest recovery. What shape that takes from here on, we'll have to wait to see. Next slide, please. So no webinar would be complete without a disclaimer, and this is your disclaimer for today. Please take a read of that and enjoy it as much as we enjoyed writing it. So that brings me to an end on the introduction. Perhaps we could just have the next slide to confirm that. And I'd like to introduce Adrian, who I'm sure most of you know. Adrian.
Thank you, Andrew. Good morning. For those who don't know me, my name is Adrian Sage, Senior Associate at McTear Williams Woods, and I'll now take you through our first session on insolvency update. Next slide, please. So since 2003, there have been few changes to insolvency legislation until 2015 and 2017, when the way IPs are appointed, how their remuneration is approved, and how they communicate with creditors all changed. Then, in lockdown in 2020, the Corporate Insolvency and Governance Act, known as SIGA, came into effect on 26th of June 2020, partly in response to COVID-19, but had mostly been previously consulted on since 2016. SIGA brings in a new moratorium, a new restructuring plan, a ban on termination of contracts in insolvencies, and some temporary COVID-19 provisions. Finally, and using Andrew's analogy of the buses, the third bus arrived in the shape of the Finance Act 2020, which came into effect on 22nd of July this year and introduced joint liability for directors, and from December the 1st this year, Crown secondary preference. As we'll come on to, both are game changers for most SMEs. Next slide, please. From October 2015, the way IPs can be remunerated changed. IPs used to be able to get fee approval on a time cost basis and book and charge this time with no restriction. But from October 2015, IPs have had to provide creditors with a fee estimate, which, if approved, acts as a cap on the remuneration that can be charged. Also introduced was more flexibility, allowing remuneration to be approved and charged on any combination of bases, including fixed time, time cost, and percentage of assets or realizations. Previously, it had to be one of the bases and you would stick with that. The overall aim was more disclosure, transparency, and engagement with creditors. The reality is very different, with creditors swamped in pages of mostly unintelligible details and minimal contact. It feels to me more like the case of the regulatory and compliance tail wagging the dog. In April 2017, the new insolvency rules were introduced. They brought in decisions by deemed consent. This is where a decision, like the appointment of an IP, is made without a single creditor vote, unless over 10% in value of creditors or object by 1 minute to midnight on the date of the decision day. Creditors can also request a physical meeting to be convened, and the rule of 10 will apply. That is 10% in value, or 10% of the creditors, or just 10 creditors. Decisions in insolvency processes can now be held by deemed consent, by correspondence, by electronic voting, or by virtual meeting. A physical meeting cannot be held unless requested by creditors using the rule of 10 method previously mentioned. The legislation changed to increase creditor engagement in the process, which hasn't really worked, and very rarely do creditors request physical meetings or engage in that process. In addition, the legislation has made changes to the way IPs communicate to creditors, which can be by giving notice to creditors and then delivering reports on their firm's website. This has been the method adopted by most firms. Finally, small debts of £1,000 or less can be deemed as proved without creditors needing to submit a formal claim. Next slide, please. SEGA came into effect on 26th of June this year and brought in the new moratorium and restructuring plan. We will be discussing how the moratorium works in our business rescue and insolvency options presentation later on. But suffice it to say that from 26th of June to 30 September 2020, there have only been 2 moratorium filings at Companies House and only 1 restructuring plan. That's because company rescue is rare outside of CVAs, which mostly don't need the protection of a moratorium. In fact, we've only ever seen 2 in our firm's 20 years. However, we can see that a moratorium could be useful for SMEs if new investors or new finance is promised, where a bit more time is required to get the deal over the line. It's also likely that large companies will use the moratorium in conjunction with the new restructuring plan, which I'm going to talk about next. Next slide, please. So the restructuring plan is a variation on the existing scheme of arrangement and is similar to Chapter 11 in the USA, which involves multiple court hearings. In a restructuring plan, creditors are placed into classes, and 75% by value of creditors in each class has to approve the plan. Next slide, please. The restructuring plan can bind secured creditors, and the court can impose the plan on dissenting creditors. But the court's only likely to do this where the plan gives the creditor class a better outcome than an alternative insolvency procedure may do. The first company to use this was Virgin Atlantic. Few people actually think it will be used by SMEs as it's too complex and expensive compared to a CVA. Next slide, please. SEGA also introduced a ban on the use of termination clauses in insolvencies, which extends the existing requirement to continue supplies by key suppliers, like utilities and internet services, and extends this to all suppliers, and just as importantly, prevents them from amending contractual terms and pricing. We don't actually see generally that this will be an issue in many insolvencies, as trading insolvencies are very rare, and suppliers are more than happy to supply, knowing they are contracting with a regulated professional. However, it will help post-appointment with regards to utility suppliers, where tariffs used to roughly double. We think the most likely applications are in fact in CVAs. There is also a COVID-19 temporary exemption for small company suppliers who meet 2 of the criteria shown on the slide during the period 26 July this year up to 30th of March 2021. Next slide, please. In addition, as a response to COVID-19, other temporary measures include a moratorium on statutory demands and petitions where the reason for non-payment is COVID-related. This was initially from 1st of March to 30th September this year, although this has now been extended to 31st of December 2020. Landlords are also prohibited from forfeiting leases until 31st December 2020. There is also a suspension of wrongful trading between the 1st of March and the 30th September this year. Wrongful trading is often raised with directors at a risk area pre-appointment, but in practice it's an extremely difficult claim to pursue. And whilst it caught the headlines for all practical purposes, it was a bit of a non-event. Next slide, please. With much wider potential, with a much wider potential application and largely under the radar, the Finance Act 2020 introduced directors' joint liability for tax abuse with effect from 22nd of July this year. This places serial phoenixism firmly alongside tax evasion. A joint liability notice can be issued when 3 companies are subject to insolvency processes in a 5-year period, and the new company is carrying on the same or similar trade as at least 2 of the old companies. At least one of the old companies has a tax liability greater than £10,000, and that is greater than 50% of the total liabilities. The relevant individual directors or shareholders are concerned in the management of the company. Joint liability covers unpaid and future taxes of the new company for 5 years from the date of issue, together with the unpaid taxes of the old companies. The law is already in, so the only way for directors to avoid this is avoid insolvency altogether or ensure HMRC does not become greater than 50% of the creditors. It still remains to be seen how extensively HMRC will use these powers to make directors liable, as it does have other more limited powers that are rarely used, for example, to make directors responsible for paying NIC deductions. Next slide, please. So the Finance Act 2020 also brings back the return of HMRC as a preferential creditor with effect from the 1st of December 2020. Like joint liability notices, this could be another game changer in our world as it winds back the clock to 2003 to make HMRC a preferential creditor again, leaving little left for ordinary unsecured creditors. This time they will be a secondary preferential creditor after existing employee preferential claims for arrears of wages and holiday pay. However, it only covers taxes collected and held by businesses on behalf of other taxpayers, and so it includes VAT, PAYE, employees NIC, student loans and CIS deductions. This is likely to have far-reaching consequences, including fewer and smaller dividends to unsecured creditors, more money for HMRC, less money for the banks, more calls under personal guarantees, and the banks may actually be less willing to lend. It could be the death knell for everyday CBAs, as dividends to unsecured creditors could be derisory. Many thanks. That's the end of our insolvency update, and I'll now hand you over to my colleague Gary Rupping for the next session on business rescue and insolvency options.
Excellent. Thanks for that, Adrian. Good morning, everyone. And for those of you lucky enough not to know me, my name is Gary Rupping, and I'm an associate and appointment taker at McTear Williams Woods. I'm going to trot through the various business rescue and insolvency options for companies. For many of you, this will be a refresher, but I'll also be covering some of the new insolvency procedures. We always exhaust the business rescue options before we get into the insolvency ones. So what I'm about to run through is in the order in which we consider them. Next slide, please. Just as with COVID-19, we have the rule of 6-2. Think of these as a cascade, where we rule in or out each in turn. If you can't trade on and out of difficulty without having to do deals with creditors, then we consider informal time to pays, or TTPs. If that is not enough, then we consider the new moratorium, CVAs, then administration, and last but no means least, the humble liquidation. Next slide, please. As my doctor keeps telling me, prevention is better than cure. If a company can avoid having to break cover and compromise with creditors, then it should. It is not unusual, almost channeling my inner Tom Jones there for a moment, for businesses to have to juggle cash flow for short periods, but not for all the time. As a company becomes distressed, it usually happens over a long period of time, and towards the end, when it deteriorates rapidly and directors have to firefight on multiple fronts, for example, when credit insurers withdraw. If the decline is not just about cash flow and revenue, and costs need to be realigned, then cut early and hard so you can see the benefits quickly. Don't be optimistic. Make sure forecasts are brutally realistic. Otherwise, you might pursue this option when other business rescue options are more appropriate. If cash flow is tight, prepare a rolling 12-week or short-term daily cash flow forecast so you completely understand the cash flow position that you're in. If your clients are thinking of introducing large trust funding, do so safely. As you'll appreciate, we had various ideas on how to do so. So who are you going to call? No, not the Ghostbusters, obviously McTear Williams Woods. If the business is struggling, it is probably insolvent or near insolvent. If so, the director's duties change from acting in the best interest of shareholders to acting in the interest of creditors. And to protect themselves, they should record decisions, take and follow professional advice. Case law is established that following professional advice gives directors a high level of protection. Next slide, please. If you can't trade on and out without doing deals with creditors, then you're going to have to enter time to pay arrangements. If a company cannot pay its debts when they fall due, it is technically insolvent. By doing a TTP or time to pay, a company can once again become able to pay within its agreed extended terms and therefore become insolvent again. Solvent again. You don't want to go the opposite way. In the COVID-19 era, creditors and lenders are expected to be more receptive to rescheduling payments. In particular, HMRCs, whose debts can build up very quickly under the current situation, is under political pressure to be lenient. We are hearing HMRCs open to reasonable offers, much like I am. Ordinarily, HMRC will extend time to pay on tax, will not extend time to pay on tax that is already in arrears. Eventually got it right. Historically, TTPs over 3 months are easy to obtain. It is usually possible to agree payments over 6 months, but it is rare to see payments spread over a 12-month period. Our advice is to include an initial payment on acceptance, and it is vitally important to keep to the TTP arrangements. There is usually no second chance. Informal TTPs with more than a few creditors also usually unworkable. Next slide, please. If informal TTPs won't work, then consider a formal moratorium using the new moratorium procedure. Once documents are filed at Companies House, there can be no legal action brought against the company for 20 days. This can be extended by creditors or the court for up to 12 months. Sounds great. It almost sounds too good to be true. I don't know how that goes. It can only be used when cash flow is so bad that the company is unable or near unable to pay its debts as they fall due, but not so bad that an IP thinks the company cannot be rescued or pay its finance commitments and other credit incurred during the moratorium. We think these circumstances will be very rare. Also, if the IP ceases to think that it will be successful, then they have to bring the moratorium to an end. For SMEs, it is likely to be used in conjunction with a CVA or buy time to get a refinance offer over the line. Next slide, please. If a moratorium won't work, then maybe a CVA could. CVAs were introduced way back in 2003 and got off to a slow start, but the decline in the high street and now COVID-19, most national retailers and casual dining businesses have either entered or thinking about doing one, as they can walk away from unprofitable outlets and reduce rents. CVAs can be used in various situations. For instance, where a company just needs time for something to happen, a contractual receipt, a sale, asset refinance, or a litigation win to enable creditors to be paid in full or in part. More typically, it is to allow a company to restructure and make voluntary contributions over 5 years. And finally, it used to wind a business up and wind it down. However, to get the necessary 75% by value of creditors to approve the CVA, it needs to offer them something significantly better than administration or liquidation could, typically around 30 to 40 pence in the pound compared to a few pence in liquidation. A word of warning though, most CVAs fail because most are based on voluntary contributions, as mentioned earlier, over 5 years. And we all know how things change, especially if the last year is anything to go by. Next slide, please. If a CVA won't work, then maybe an administration could. In 2003, administrations became mainstream when banks could no longer appoint administrative receivers under new debentures. The major advantage of liquidation is that it creates a moratorium, stopping creditors from taking enforcement action, which can assist in the sale of a business as a going concern. Most administration appointments are made by a company's board of directors, but a lender with a floating charge has a 5-day window period to override the director's choice and appoint their own from their panel. In 2003, no one had ever heard of a pre-pack administration, but they quickly became to the fore, and even today, the majority of administrations are pre-packs. Now, what is a pre-pack? A pre-pack is where the sale of the business and assets is negotiated prior to the administration and completed either at the same time or soon thereafter. Over the years, pre-packs have got a bad name, seen as cosy deals behind closed doors, and are increasingly regulated, so that today there has to be quite a substantial amount of open marketing and detailed disclosure to creditors soon after the deal is done. Pre-packs are currently under review, and the government has said it will legislate that all pre-packs have to be independently scrutinised from 2021, or April 2021, the next year. I think it's April Fool's Day as well, ironically timed. Administration hardly ever ends in company rescue, which is the primary statutory purpose, and is generally ended by moving the company into dissolution or liquidation. Next slide, please. Finally, if administration won't work, that leaves the good old liquidation. Liquidations followed the introduction of limited liability companies in 1844, so hardly a new insolvency procedure. So this is used when a company has reached the end of the road. A solvent liquidation, known as a members' voluntary liquidation, or MVL, pays a surplus to shareholders at beneficial tax rates via the capital gains route and entrepreneurs relief. An insolvent liquidation can be a creditor's voluntary liquidation, or CVL, initiated by the directors and approved by the shareholders, or a compulsory liquidation, which is made by a court order. The latter process takes 2 to 3 months, is quite costly, and results in a civil servant known as the official receiver being appointed. Directors will therefore generally opt for a CVL because it is quicker and they get to choose their RP. A run of case law in Europe and the UK has turned business rescue on its head. The Insolvency Act positions administration as a company or business rescue procedure. The case law has determined that 2P liabilities apply, or 2P legislation applies to administration sales, so that any and all employee liabilities transfer to a purchaser. That same case law has determined that 2P doesn't apply to business and asset sales by a liquidator. For most SMEs, whether employee liabilities transfer will make or break a sale of a going concern and save jobs. Also, in a CVL, all the regulation around pre-packs does not apply. And if you follow the right procedures, a director's successor company can continue to use the name. So whilst liquidation is the last insolvency option, it is by no means the least. I hope you found that trot through of the options informative. Now we'll make way for Andrew again.
This is Andrew masquerading as Hayley Watson, but
I did want to say you don't look like Hayley.
So, which Hayley is very relieved about. But Hayley couldn't be with us today, so I'm stepping in. So we have about 150 new insolvency appointments a year, and through those we see all sorts of directors' conduct, some very good and some very bad. Through that experience, we've identified the top 10 things that directors should avoid or not do to avoid the worst, or do, in fact, to avoid the worst pitfalls. Next slide, please. This is in a kind of logical flow, hopefully you'll find. The first thing is to know the financial position of the company. If you don't know it, you're not likely to be making good decisions. Exactly what information you need will vary depending on the size and complexity of the business. But at a minimum, directors should have up-to-date management accounts and be able to see that the company has enough cash flow for the foreseeable future. If cash flows is tight, as we've touched on, then directors should have a 12-week or daily rolling cash flow forecast to keep an eye on that. The next thing is, if you know where you are, that's not enough. You also need a plan of where you're headed, and that needs to be realistic. Directors should ideally have forecasts that include integrated profit and loss, cash flow, and balance sheets, and know monthly where cash stands at the end of each month, or if cash flow is tight, then more frequently than that, using the weekly or daily forecast. So you know where the company stands and you know where it's headed, but it still might not be good. It might be in a bad position, and it might be headed for a worse position. So in that situation, seek professional advice and seek it early. The main device, if you like, for directors to identify they need professional advice is the short-term cash flow prospects for the company, so that I would be focusing on the 12-week rolling cash flow forecast. And if that shows you're running out of cash and won't be able to keep the company trading, then really at that point that you identify that, you should be seeking professional advice. Now that can be from a lawyer or an accountant, but seek it and follow it. There's a case called the World of Leather case, went through the UK courts, and that found that as the directors had taken and followed professional advice, they had acted properly. At McTear Williams Woods, we provide free advice to advisors on both named and unnamed basis, and direct to companies, and take advisors and directors through this at every stage. Hopefully, having done all that, you'll be fine, but if you're not, then there is a pitfall to avoid, and that is not letting Crown debt get over 12 months in arrears. Insolvency law requires that all creditors are treated equally, but in reality, HMRC often get left behind. Where Crown debt's over 12 months, that is a red flag and is something that can lead to director disqualification. Also, where it builds up to that extent, it's quite likely that Crown debt will be over 50% of all the creditors, and then that puts directors in line for a joint liability notice that we touched on earlier. So, having done all that, what if the company is still headed for the rocks? Well, one thing directors can do to improve their lot is have a contract of employment, have a written contract of employment, and pay themselves through payroll with PAYE and NIC deductions, because that will help the directors claim for redundancy, pay in lieu of notice, arrears of wages, and for a lot of directors who have long service, because quite often they're founders of their companies, so they have all the years service since incorporation, that can easily give rise to a £15,000 claim that the government will pay on insolvency, and that claim's much easier to make with a written contract of employment. Next slide, please. So Mike is going to be talking shortly about unlawful dividends and the interplay with outstanding director loan accounts. So I won't say too much on it, but you should stop paying dividends and start paying salary if there aren't distributable reserves, or if the business becomes distressed. At that point, our view is it's fine to pay a market salary. So if the director's been paid, let's say up to the NI limit for a number of years, but the company comes into distress, stop doing dividends and start paying market salary. And maybe the company doesn't have the money to pay a market salary, but that salary can be set off against the DLA and improve the director's position in the event of an insolvency. So a lot of shareholder directors and you know, for most of the businesses that we deal with, the directors are the shareholders, or significant shareholders at least. They do consider, and often do, put in money to try and rescue the business, and run up credit cards and generally extend themselves to keep the business going. And that's fine, but if you're going to do that, be smart about it. And we would suggest buying an asset, and then the company can have the option to buy that asset back, perhaps in the future, either formally or informally. And Phil Bailey's going to be saying a bit more on that later on. So the other thing we would suggest is for directors to have a plan B. It speeds up decision making if difficult decisions have to be made, and it helps the directors understand what their options are and keep their current plan under review against the next most viable option that they've been able to identify. And finally here, in terms of our top 10 tips for directors, is they shouldn't let the situation get them down. If it does, it's almost certainly gone too far. And if they're not able to sleep at night, if they're worried about the situation, that's almost certainly a good test that the directors should be taking specialist advice. There's almost certainly a better way. So thank you for that. And I'm saying thank you to myself, really. So we're now going to have a session on buying a business from an IP, and I think that's Gary again.
Hi there. Thanks for that, Adrian. Andrew, even. So you've all drawn the short straw, and you're now going to listen to another session of my dulcet tones. As Andrew says, I'm going to run through the top tips when buying business and assets from an IP, mostly from the view of a director looking to buy their insolvent company's business and assets. This is because the majority of business and asset sales done are back to a former director's new company, basically. Next slide, please. If a director is going to buy the business and assets back from an insolvency practitioner, they should want to do so when the company is in the best shape possible, when its customers and share supply base is intact. If you leave it too late, key customers and employees will have gone to competitors. Also, if the decline becomes drawn out, the directors may have to put in all their personal savings into it to keep it going and save it, and have nothing left to fund the new company, and potentially find themselves in the breach of director's duty and face claims and potential director's disqualification. So it's the worst of all potential outcomes. As well as getting the timing right, directors need to choose the RP carefully, because they need to ensure the RPs are commercial, pragmatic and fair. Of course, if directors have any trouble finding a good RP, we'd be happy to point them in the right direction. Most business and asset sales by an IP have to be done quickly, because otherwise, after a very short time, there will simply be no business left to sell. Think days or hours, not weeks or months, which normally take place in a corporate finance transaction. So the successful purchaser needs to know what it wants to buy, how it's going to pay for it, and be able to put money on the table at completion. And that is just a start, because they also need to have working capital ready and a clear plan for the new business. As you can appreciate, this takes quite a bit of time. And the sooner you start to plan, the quicker you'll be able to move and the greater the likelihood of future success. When buying a business and assets, the IP will give no warranties other than that they have been appointed, have the power to sell such right and interest and title as the company has in the assets and business, and caveat emptor applies. Let the buyer beware. That's what happens when you get the South African, to quote Latin, completely cock it up. In COVID-19 era, the timing of insolvency appointments and business and asset sales is more critical than ever. If they can, we are seeing directors delaying that process while sales are substantially down, which is right, completely understandable. And as they don't want to saddle their new company with the overheads, although this runs a greater risk of breach of fiduciary duties and other directors' duties. Alternatively, directors are also looking to buy the assets and mothball them until we get to the other side of this, whenever that is going to happen. No idea. Next slide, please. When you're negotiating, it's all about the art of the possible. You shouldn't make an offer you cannot deal. You cannot deliver. But ideally, you should ensure that there's enough cash there on completion for the ex situ auction value of the tangible assets. You should also be paying some premium over this ex situ value or for goodwill. This varies quite a bit depending on the business that you're talking about, but typically will be 50% above ex situ values. Next, you negotiate to pay for stock of work in progress as it is used, or pay up front as a substantial discount, which can produce a super profit in year one. One thing that often gets missed is to offer to collect out book debts for a 15% commission of realization. This is because you already know the customers and you'll be wanting to deal with them anyway for your future business. If buying the business and assets, you need to be wary of buying from an administrator. Assist on the insolvency process being a liquidation. As for those who were paying attention earlier, you can potentially avoid 2P liabilities. In recent cases we advised on, this has resulted in 2P liabilities of over £150,000 being avoided. Understandably, employers also like to be made redundant, as they get a substantial payment from the redundancy payment service, and potentially the next day find themselves in a new job, usually on the same terms. An employee with 10 years service paid at or above the statutory limit of £538 per week will typically receive a lump sum of over £13,000. I can completely understand why employees are looking for that. Suppliers will be very wary, however, so don't expect credit for the first few months, and NewCo will in all likelihood have to provide sweeteners to secure future supplies, often paying slightly above the normal rates as a bit of a premium. Most major banks won't provide bank accounts or facilities to Phoenix companies. What is a Phoenix company? Those are companies that have purchased the business and assets from an insolvent company with the same directors. So do your research ahead of any deal and make sure you plan. I hope you found that trot through very useful. I think I'm now going to make way for Mike Jenner.
Gary, thank you. How do you follow up Gary Rupping? So my name is Mike Jenner. I'm an associate director from McTear Williams Woods, based in London, and I'm going to be talking about the position that so many directors find themselves in inadvertently because of not monitoring the situation correctly with regard to dividend payments and the collateral damage that can occur in relation to their loan accounts. We currently have in the region of about 300 open insolvencies at the moment with McTear Williams Woods, and of those, there's a fairly large percentage of cases which actually do have issues arising from dividends that have been paid in an unlawful manner. Because it's such an important subject, and it's quite a technical one, which the lawyers amongst us today will know there is an awful lot of case law on it, including some very recent case law. I've been given 10 minutes to talk about it. So we are going to whip through it with a bit of speed, and it's not going to be particularly technical. So apologies for that. So we all know, sorry, next slide, please. So we all know that most SMEs pay director shareholders their salary predominantly through dividends, with a small amount paid for to take account of the NIC band and also the lower limits for tax allowances. And this works perfectly well until the company becomes insolvent, or just the distributable reserves dry up and the company becomes no longer profitable. As I say, perfectly fine and perfectly legal to do it that way. The difficulty comes when the company goes into insolvent liquidation. Number one, any unlawful dividends that have been paid may have to be overturned and restored to the company under Section 847 of the Companies Act 2006. And if any director's loan account has been reduced or expunged because of unlawful dividends being credited to it, it's likely that the position will have to be reversed by a liquidator, and the director will again become indebted to his company. And it's worth bearing in mind that in the last few years, HMRC have really woken up to the situation with unlawful dividends and are pushing insolvency practitioners quite heavily to ensure that action is taken to restore them. It's also important to remember that dividends can't retrospectively be reclassified as remuneration after the fact. There's well-settled case law on this. If they're declared as dividends, they must be treated as dividends, and it's not enough for a director to say, but it was really salary. And the reality is, we know that the director is just treating those drawings as salary. But the law doesn't see it that way. And in the event that an action is taken against the director, he is going to have to repay all of the dividends that were paid unlawfully to him. In other words, those that actually exceeded the distributable reserves. And as such, he may end up having had no salary at all for his services to the company, which is obviously unfair. And just to pile on the problems for our poor director, it's worth bearing in mind that there might be circumstances where a director may be held accountable for distributions made, unlawful distributions made to other individuals. So, for example, shareholders who aren't directors, who aren't privy to the financial records of the company, or made to his fellow directors where perhaps the claim is irrecoverable against them because, for example, they may have gone bankrupt. So in addition to a claim against themselves for the unlawful dividends, they might find themselves accountable for a breach of duty claim for causing or permitting unlawful dividends to other parties. And that would be under Section 212 of the Insolvency Act 1986. So how do your clients avoid all of this grief? Well, the most obvious answer is don't pay yourself through dividends, but that's not practical, it's not workable, and it's not necessary as long as precautions are taken. And when the spectre of insolvency starts to loom, a director needs to switch from dividends to salary, and we'd certainly recommend this. Next slide, please. As Andrew was saying earlier, it's important that the director has a written contract of employment or a service agreement, and that the salary disclosed in that contract is at a market rate. Another benefit for directors who have long service and a contract of employment with the company, as Andrew said earlier, they can get payments from the Redundancy Payments Office, which can be a 5-figure sum. Next slide, please. It's essential that any expenses that are incurred by the director personally are reimbursed to him or posted to any DLA on a regular basis, and to ensure that the DLA itself doesn't accumulate by ensuring that any interim dividends that the company can lawfully pay are regularly posted against the DLA. But please remember, interim dividends have no legal standing until paid or posted to the company's records. But the most important thing of all is the director must keep on top of the company's financial situation and switch to payroll immediately there is an issue, even if it's only a temporary hiccup. And remember, even if there are distributable reserves, a director still has an obligation to act in the interests of the creditors of the company and consider the effects that the payment of a lawful dividend might have on the company's cash reserves. And if a director has paid a creditor under his PG, this can be set against his DLA. A quick word about coronavirus. If the company has made an application for government support under the Bounce Back Loan Scheme or the Coronavirus Business Interruption Scheme, this isn't necessarily an indicator that the company is in distress, merely that it's suffering effects of COVID-19. However, due to the effects of the pandemic and the unpredictable nature of what is going to happen and what government initiatives might be introduced in December, perhaps, or beyond, directors need to be cautious about the fact that their companies are more vulnerable than they've ever been before for factors that are effectively an act of God. So they need to be aware that they should be considering switching to payroll, even again, just as a temporary measure. Adrian mentioned about SEGA earlier and the various relaxations that have been brought in by the government, powers that a liquidator has to bring claims against a director for wrongful trading, for example. But it's important to remember that Section 847 of the Companies Act 2006 isn't amongst these, and therefore the liquidator is still going to have a power of redress on behalf of a company in relation to any unlawful dividends that have been paid. So, as I said, that was a very quick run through of what could easily have, is a subject matter which could easily have a whole webinar devoted to it. And it's possible we might do that in the fullness of time. In the meantime, we did actually send out an e-shot on the subject matter, giving guidance on unlawful dividends. And I think that was in April of this year, and that's still available on our website. I'm now going to hand over to Phil Bailey.
Many thanks, Mike. Good morning. My name is Phil Bailey. I joined McTear Williams Woods in September of this year, following a 28-year career with Barclays. In the last 10 years, I've headed up a recoveries team for the bank, and I've also, more importantly, worked as a turnaround director, helping SME companies avoid going to recoveries in the first place. I'm now going to talk about how directors can keep their lenders on side and illustrate this with a few examples. Next slide, please. If the business is in distress, be very clear about what is possible. Do not go to the bank unprepared. Even if you do have a very friendly manager, beware, they are not the ones that are going to be sanctioning your request. There are a lot of nervous sanctioners out there at the moment, trust me. If the case does go to recoveries, there might be a case review on it, and no sanctioner wants to be the last person who lent additional monies on a case that then went bad. Remember, this is not a normal negotiation between equal parties. Do not go in high, hoping for at least a smaller amount. If you ask for too much, I'll spook the bank. They may say decline it straight away or put you in special measures. Ask for a small amount and be very clear about what the extra advance is for, and also be very clear about when you're going to repay it. Under promise and over deliver. If you said you get the overdraft down in 6 months, then do so. Be brutally realistic, as we mentioned before, with your financial planning. Don't miss any milestones. I have known directors to ignore some milestones, and formal demand is issued then very quickly, and the LPA receiver is summoned. If you have bad news to deliver, then it's best you prepare it with some solutions and have a financial pack ready to discuss with the bank. Please get in. The bank may insist on an independent financial review, so it'd be worth speaking to us first and prepare all the options and prepare the information. Then you're in control of the situation. Personal guarantees. We mentioned earlier that, I say, personal guarantees are always payable on demand and they give you no control. These are usually limited, but if you do come across any unlimited guarantees for your clients, please do let me know. These should only be historic and they shouldn't be being used now. Once guarantees are in place, they're very hard to get rid of. Even if the company repays all its debts, I have been known that banks keep hold of them anyway, because obviously if there's no debt to repay, there's no call upon the guarantee, but the company may need to borrow in the future, so the guarantee stays in place. We would always recommend, if you're going to put in your own money, then, as we've mentioned before, buy a company asset. Banks do like it when owners, shareholders and directors put in their own money, and they are less concerned about the release of some of the assets, which in a gone concern, they may not be able to recover much, or it'll cost them a lot to recover it anyway. So they look upon this favourably. If it is a large asset or a large amount, then do check with the bank first. But we often hear directors say they wish they'd spoken to us before putting money in, as they end up as an unsecured creditor and get very little out of it. So buy an asset if you can. Finally, in my time in recoveries, I've been surprised how many directors and owners have said that they wish they'd done this sooner. They wish they'd sought advice sooner, and they can now get on with their lives, that the whole process wasn't as painful as they first thought. So do remember that when you're speaking to your client. Sometimes the fear of what's going to happen is a lot worse than what does actually happen. And finally, I'll give you one example of a hotel owner that I dealt with once. It was his life ambition to run a very large country hotel. After a few years, he was heavily in debt and clearly out of his depth, but he didn't want to release the asset. The key to unlocking this was finding out what he enjoyed doing, and the occupancy rates and the financial stress is something that he wasn't very well suited to. He's now, I'm pleased to say, running a very successful large B&B, and having decided to sell the hotel, the lender was very helpful in supplying him with extra funding to get the sale ready, and a consensual sale happened, which allowed him to clear his debts and allow for a lump sum to set himself up. So it is hard to get people sometimes to change their fixed views, but as professional advisors, I think it's our duty to discuss all the options, even if some customers may decide to discard them. Have those difficult conversations now. It makes for easier decision making later. If your clients have any issues on how to keep lenders on side, please do get in touch with me, even if it's on a no-name basis. I'd now like to hand you back to Andrew.
So thank you very much, Phil, and thank you very much, team, because according to my watch, that almost exactly took an hour. And how impressive is that? So we've now got a Q&A session. I don't know if you can see what I can see on your screens. But there's one question popped up. So if you've got any questions, now's your moment. Let's be having it. But there is a question here, which is if a landlord won't agree a deferral of rent, but the tenant tries its hardest during and after COVID to pay what it can, is it trading whilst insolvent? And I think the answer to that is yes, it probably is trading whilst insolvent. But trading whilst insolvent is not actually prohibited under the Insolvency Act. But it is a term that the official receiver uses in connection with director disqualification. So, and the courts do recognise it as an issue, even although there's no legislation on the point. But the chances are the company is insolvent if it's not paying all its creditors as they fall due, COVID or no COVID. And therefore, all the usual provisions that apply, come into play. So directors need to act in a way that minimises the loss to creditors. They need to act in the interests of creditors, and any transactions at an undervalue, any preferences, breaches of duty could all become problems. It's going to be interesting how the courts sort of interpret all that if claims are brought in relation to trading during COVID, and I suspect the bar will be set, fairly high, just because one or two creditors are not getting paid. That isn't necessarily, I think, going to tip the courts into saying that the company is insolvent. But we'll see, and every court has a different judge making those decisions, so there'll probably be a range of outcomes. So I hope that answers that question. I see another question here. As I'm a tax partner, I'm already starting to see HMRC becoming less amenable to time to pay. Have you seen any evidence that HMRC's preferential change on the 1st may lead to this, with the expectation that HMRC will be more aggressive? We haven't. Obviously, we've not reached that date yet, although it's on the horizon. I think generally HMRC are quite sensitive to adverse publicity, but yeah, you're right. With them becoming a secondary preferential creditor, it's kind of going to be more in their interests to tip a company into insolvency and take their chances in that insolvency. So we haven't seen it, but it is a possibility. I think really, though, they will, I don't think they'll change their behaviour that much. Certainly on time to pay agreements, they've always not liked people missing a payment and trying to renegotiate another time to pay agreement. I don't know if that's the situation you've got there. So if you're trying to negotiate a time to pay agreement and spread things over 12 months, our experiences at HMRC are going for that. But if you miss that and try and renegotiate another one, they probably won't play ball. Okay, so we've got another one. I asked Gary about this a while ago, so maybe Gary can answer it, but wondered if views are changing. I'd like to serve a statutory demand on a company who refused to pay. I believe I've got a good claim, but do I have to wait until the new year? I don't know what answer you gave, Gary.
It's testing my memory there a little bit, but it's on that point about the trading whilst insolvent aspect, and I think that's I think it is. Do you have to wait until the new year? Probably not. I'd want to be sticking it in personally. Well, that sounds really inappropriate, but I'd like to be sticking the statutory demand in. But I think there is restrictions at the moment. I don't know if that's expiring 1st of December. When are the restrictions on serving stat demands?
No, that's the 31st of December, Gary.
31st of December, yeah. I've got it December in my head. I couldn't remember if it was the beginning or the end. But yes, I don't think you can really issue a stat demand as yet on those issues. Is that correct, Mike? You're looking like I've misquoted there a bit.
So I mean, you can, but they've got a defence, which is if the non-payment of the debt is caused by COVID, then that gives them a sort of get out of jail card. I have to say, we've got a number of situations where we're looking to serve statutory demands and petitions on insolvency cases that we're running, where we're doing debts and claims. And we've decided to put all those on hold until the 31st of December. So because people are going to put the non-payment down to COVID, even if that's not the real reason, they're almost certainly going to be able to come up with enough of a reason to persuade a court that COVID has got something to do with it. Okay, any more questions? Ooh, there we go. We've got 36 of you. I can't believe you haven't got a question. So I'll just give you an opportunity to think if you have or you haven't. Perhaps I can try you on a question we were asked at another one of our webinars, which is what is going to cause corporate insolvencies to start to rise? Because as you saw from the chart I threw up earlier, they've actually dropped, and at one point they actually halved. They've come back a little, but only a little, and they're well below pre-COVID levels. And what's caused that? Well, it's cash flow. The thing that drives companies into insolvency isn't really profits and losses directly. It's whether they've got the cash to keep the business trading, and actually that boils down to whether they've got the cash to pay the wages as much as anything. And so when businesses run out of cash is when they will face up to insolvency. At the moment, they've got their VAT deferment, they've got their bibbles, they've got their civils, they've got their grants, and they're potentially sitting on more cash than they've ever had, but perhaps are burning through that. And companies will burn through their cash at different rates. And so when COVID happened, I rather thought there might be a tsunami of insolvencies, but that certainly hasn't happened. In fact, quite the opposite. And what I'm now seeing is that there'll be more a gradual swell because there's been a lot of kicking the can down the road by the government, and companies have got some cash, and I think they're not going to be taking decisions about insolvency processes until they really have to. And it's understandable because with COVID-19, we're in uncharted waters, and they want to wait and see how things happen, whether their business will come back. And obviously they want to give that as long as possible before taking a decision which is irreversible, which obviously something like liquidation or administration is. So that I think is going to mean that insolvencies will rise gradually and probably really only from the beginning of next year. And until then, I think they'll probably remain low. So there's a question you didn't ask, but you got an answer. We've still got 35 of you, so I won't keep you. And unless another question pops up there in the next few seconds, then I'd like to thank you all for attending today. We've got another slide just to confirm our thanks, so perhaps Charlotte can throw that up. And then there is a quick survey, which, if the technology is working, we'd be grateful if you would complete that and give us some feedback, so we can try harder next time. So thank you very much for attending, and we hope to see you all in person on the other side of COVID. Thank you.
Thank you, everyone.